Hello friends. If you're 65 or older, there's something happening with your taxes right now that could put up to $12,000 back in your pocket. And I promise you, almost nobody is talking about this the right way. The SSA and the IRS have quietly rolled out a change for 2026 that seniors need to know about. Because if you miss this, you could be leaving serious money on the table this tax season. I'm John, and this is John Retires, where we break down exactly what's changing with your benefits and your money so you're never caught off guard. Before we go further, tell me quickly in the comments, where are you watching from today? I love seeing how many places we reach with these videos. Now here's the thing. There's one small detail buried in this new deduction that trips up almost everyone who tries to claim it, and if you get it wrong, you could delay your refund or miss out entirely. So stick with me to the very end, because I'm going to walk you through exactly how to claim this correctly, step by step. And if this helps you, do me a favor, hit that like button, subscribe, and turn on notifications so you never miss an update like this again. All right, so let's get right into it, because I don't want you to miss a single detail here. This new senior bonus deduction is one of the biggest tax changes to hit retirees in years. And honestly, most people are still confused about what it actually is, so let's clear that up together right now. Back in the summer of 2025, a piece of legislation called the One Big Beautiful Bill was signed into law, and tucked inside it was a brand new tax break specifically for people 65 and older. This isn't the old age-related deduction you might already be familiar with, the one that's been around for years. This is a completely separate, brand new bonus deduction. And that distinction matters a lot, because it means you could be entitled to both at the same time, stacked right on top of each other. Here's how it breaks down in plain English. If you're single and you're 65 or older, you can claim an extra $6,000 off your taxable income. If you're married and both you and your spouse are 65 or older, that doubles to $12,000 combined. And I want you to really sit with that for a second, because this isn't a tax credit that just knocks a little something off what you owe. This is a deduction that reduces the actual income the IRS counts when they figure out your tax bill. That's a meaningful difference, and it's why this has so many retirees excited. Now, here's where people start getting things twisted, so pay close attention. This new bonus deduction is separate from and in addition to the extra standard deduction that's already existed for seniors for a long time. You know the one, if you're 65 or older and you take the standard deduction, you already get a little bump added on top. That older provision is still there, it hasn't gone anywhere, and it actually got a small inflation adjustment for the 2026 tax year too. So what you're really looking at is layer upon layer of deductions stacking together. First, you've got your regular base standard deduction that everybody gets. Then you add the existing extra amount for being a senior. And now on top of that, you add this new $6,000 bonus, or $12,000 if you're a qualifying married couple. When you add all of that up for a single filer, you could be looking at a total deduction north of $23,000. For a married couple where both spouses qualify, that number can climb close to $47,000. That is a massive chunk of income that never even gets taxed in the first place, and that's exactly why I wanted to bring this to you today. Because too many seniors are going to file their taxes this year and completely miss out on part of this stack simply because nobody explained it to them clearly. Let's talk about who actually qualifies, because this is where the mistakes really start piling up. First, and most obviously, you need to be 65 or older, but here's a detail that trips people up constantly. The IRS doesn't look at whether you're 65 right now, today, while you're watching this video. What matters is whether you turn 65 by the last day of the tax year you're filing for. So if you're doing your 2026 return, you need to have hit that 65th birthday on or before December 31st, 2026. And here's a sneaky little detail that almost nobody knows. There's actually a rule, sometimes nicknamed the birthday rule, where if your 65th birthday lands on January 1st of the following year, the IRS treats you as if you turned 65 the day before, meaning December 31st of the prior year. That one quirky rule alone has let plenty of New Year's babies claim this deduction a full year earlier than they assumed they could. If that describes you or someone in your family, do not skip past this point. Go back and check your exact birth date against this rule before you assume you don't qualify yet. Next, you need a valid Social Security number on your return. If you're filing with an ITIN instead of a Social Security number, unfortunately, this deduction is off the table for you. And this next part is important for married couples specifically. If you are married but you file separately from your spouse, in most cases you're going to lose eligibility for this deduction entirely. The law strongly favors couples who file jointly. So if you've been filing separately out of habit or for some other reason, this might be the year to sit down and actually run the numbers both ways, because filing jointly could unlock thousands of dollars you didn't know you were leaving behind. Now let's talk about income, because this is the part that catches so many people off guard. And it's honestly the detail I was hinting at earlier in this video. This deduction is not available to everyone, regardless of how much they earn. It phases out as your income goes up. If you're single, the phase out begins once your modified adjusted gross income crosses $75,000, and the deduction disappears completely once you hit $175,000. If you're married and filing jointly, that phase out range starts at $150,000 and disappears entirely at $250,000. The way the phase out works, for every $1,000 your income goes over that starting threshold, your deduction shrinks by roughly $60. So if you're sitting right near that threshold, small decisions you make throughout the year, like whether to pull extra money out of a retirement account or whether to sell an investment that triggers a big capital gain, can actually push you over the line and shrink the very deduction we're talking about today. This is exactly the kind of mistake that costs people real money, and it happens more than you'd think. Picture a retired couple who's comfortably under the threshold most years, but they decide to sell some stock they've held for decades, or they convert a chunk of a traditional IRA into a Roth account in the same year. A one-time event can spike their income just enough to knock out a big portion of this bonus deduction, sometimes without them even realizing it happened until they see their tax bill. If you're thinking about doing something like that this year, a Roth conversion, selling property, cashing out investments, please talk to a tax professional first and ask specifically how it might affect this deduction, because timing genuinely matters here. On the flip side, there are smart, completely legal ways to help keep your income under these thresholds so you can capture the full deduction. If you're 70 and a half or older and you have to take required minimum distributions from an IRA, you can direct that money straight to a qualified charity instead of taking it as taxable income yourself. That move, called a qualified charitable distribution, satisfies your required withdrawal without adding a single dollar to your taxable income, which can be a powerful way to stay under the phase-out line while still doing something generous. Maxing out contributions to accounts like a health savings account, if you're still eligible, or a traditional IRA, can also help lower your modified adjusted gross income and protect this deduction. I also want to gently clear up a myth that's been spreading around social media because I've seen it repeated so many times, and it's simply not accurate. Some people are calling this the end of taxes on Social Security altogether. That's not quite what happened here. This law did not directly eliminate taxes on Social Security benefits, and it didn't change how Social Security itself works. What it did was create this new deduction, which, for a lot of retirees, indirectly reduces how much of their Social Security ends up being taxable, simply because their overall taxable income drops so much. For some seniors, especially those whose income sits mostly on Social Security and modest retirement withdrawals, this new deduction combined with the existing deductions can be large enough that very little, or even none, of their Social Security ends up being taxed this year. But that outcome depends entirely on your personal numbers. It's not an automatic blanket rule for every single senior in the country. So please don't assume your Social Security is now completely tax-free without actually running your own numbers or having someone run them for you. So how do you actually go about claiming this? The good news is you don't need to itemize your deductions to get this bonus. Whether you take the standard deduction or you itemize things like mortgage interest, medical expenses, or charitable donations, you can still claim this new senior bonus on top of whichever method you choose. It gets claimed right on your Form 1040 or the version specifically designed for seniors, Form 1040 SR, when you file this year. The key things you need ready are proof of your age, meaning your birth date needs to be accurately reflected on your return, a valid Social Security number, and an accurate calculation of your modified adjusted gross income so you know exactly where you land on that phase-out scale. If any part of this feels overwhelming, that's completely normal. Tax law changes like this one confuse plenty of people, including folks who've been doing their own taxes for decades. This is exactly the kind of situation where sitting down with a tax preparer, even just for one season, can pay for itself many times over if it means you capture this deduction correctly instead of guessing or accidentally leaving money behind. And if you've already got a preparer, do yourself a favor and specifically ask them, by name, about the senior bonus deduction from the one big beautiful bill, just to make sure it's being applied correctly on your return. Before we wrap up, I want you to really think about what we just covered. A brand new deduction worth up to $6,000 if you're single, or $12,000 if you're a married couple where both of you qualify. It stacks on top of deductions you're likely already claiming. It's available whether you itemize or not. It has a sneaky birthday rule that could apply to more people than you'd expect. And it phases out based on income in a way that rewards a little bit of planning. If any of this applies to you, or to a parent, a neighbor, or a friend who might not have heard about it yet, please share this video with them because I guarantee you there are people in your life who are about to file their taxes without knowing a single word of what we just talked about. And if you found this helpful, make sure you like this video, subscribe to the channel and turn on those notifications, because we're going to keep breaking down exactly what's changing in Social Security and retirement taxes so you're never caught off guard again.